How do I bear up in a bear market? If you are an investor who remembers the mortgage debt crisis of 2008 to 2009, you know that the market lost significant value. From an investment standpoint, the real downside occurred precisely when some investors sold off their equity holdings due to fear midway or near the end of the market devaluation. The people who financially survived this market anomaly were the ones who did not sell their good equities held within investment funds. Many risk-adverse investors who may have preferred to sell but did not, in the long run received a blessing in disguise. They had an opportunity to hold on and patiently watch their funds' unit values increase again. The current market has many investors concerned over the euro debt crisis, which is a continuation of the lack of financial regulatory governance witnessed in the mortgage debt crisis. Massive debt held collectively by individuals, companies, or sovereign nations can have an indirect effect on currencies, bond markets, interest rates, corporate banking, and/or national solvency, posing financial risk for the world's capital markets. Don't mess with nature. If there is a warning of a hurricane, you know it's coming and don't pitch your tent near the beach. With the stock market, you rarely know when a bear market is coming. Investment fund managers will work to retain your value, looking forward to the market's recovery. The nature of the market is cyclic. The smart investor who is well studied and cautious is nevertheless a risk taker, realizing that one must hold on until the stocks held in the fund portfolio regain any lost value. What can you do to mitigate a bear market? Move fund monies early. Most funds allow you to move a portion or all of your money into money market, bond and/or balanced funds amidst a fund family, those offered by the same company, or your advisor may be able to move them into an alternative investment vehicle. Buy more fund units when prices drop. Consider seeking opportunity among bargain-priced fund units. In this way, wealth can be created when buying stocks of companies held by mutual funds when they are priced lower. If you take this strategy, you must be ready to stay invested over the long haul. Dollar cost averaging involves buying fund units at regular intervals, investing the same amount of money each time. Thus, you buy more fund units when the value is lower and fewer when higher. Dollar cost averaging is probably the single smartest investment strategy to utilize during a long-term bear market, because you increasingly purchase more fund units at lower prices. If you are not fully familiar with the benefits of that concept, talk to your investment fund representative. Insofar as you realize the risk of investing to produce long-term gain and beat inflation, you can make bear markets work for you if you are patient. This is because a bear market paves the way to the next bull market when rising prices may take your investment funds higher in value. Talk to your advisor before making any financial decision. The publisher, Advice On, offers this service for educational purposes only.